Hey, what's going on, guys? This is Greg with Ideal Trading Ideas, and today is July 31st, 2021. And as you can see, we have Hanesbrands up on the screen on our Robinhood platform or our portfolio. And what we want to do is tell you this is going to be our trade idea number 21. This is what we're thinking right now, trade idea number 21. And we're going to be doing a poor man's cover call. So anybody that doesn't know what a poor man's cover call is, it's going to involve us getting a long-term options contract, a buy call options contract or leaps option contract, and then we're going to take covered calls against it. So right now, Hanesbrands is going to be our example, currently valued at $18.26 per share. It's down 10 cents for the day, or negative 0.54%. Nothing after hours. We're going to run through the chart really quick. Weekly chart says that we're up 24 cents or positive 1.33%. Monthly chart says that we're down 51 cents or negative 2.72%. 3-month chart says that we're down $2.97 or negative 13.99%. 1-year chart says that we're up $3.86 or positive 26.81%. And the 5-year chart says that we're down $8.60 or negative 32.02%. So how do we do these cover calls, right? Or those poor man cover calls? First thing you want to do is go to trade HBI options over here on the right. We clicked on that, and now we have the options chain. This whole thing is called an options chain, and it's different from other platforms, right? Robinhood has a more simplistic option chain, at least in my opinion. But anyway, we have buy, sell, call, put, and we have expiring August 6th, right? So this is going to be next Friday. So remember, from looking at the other videos, the poor man's covered call or the covered call videos and the cash secured put videos, you know that with the covered call video, you would have to just buy the shares straight out, and then you would put them up for sell calls in order to make some money, right? With the poor man, with the cash secured puts, you would have to have the cash available as collateral to say, hey, I'm willing to buy 100 shares at $18 or $17.50 or whatever the amount is going to be. You would have to have that amount of cash up front, which is going to be $1,800 just to get in on that. But the poor man cover call is going to be different, right? It's not going to be that much cash at all, and you're going to be able to still earn money on a monthly, or really on a weekly, bi-weekly, tri-weekly, or even a monthly basis. It's just up to you. So first thing you want to do is make sure you have your buy and your call highlighted, right? You're going to change your expiring date from August 6th, and you're going to roll down to January 2023, right? So you want a long-term contract, right? You're going to scroll back up. You can click on the share price for it to kind of jump up for you. And we're going to take a look at the $17 strike, right? So we have strike price, break even, to break even, percentage change, and price. So we're going to be looking at the $17 strike. And then we have a premium right here that has to be paid out, $3.50, right? So $3.50 times 100 shares is going to be $350. Now, when we add the $17 strike and the $3.50 premium that has to be paid out, that's going to come up to $20.50, our break even, which means when we decide to go ahead and start doing cover calls against this long-term options contract, we have to be at $20.50 to break even for the contract, which means that if the share price goes from being $18.26 up to $20.50, we could break even without owing any money out there, right? We can get our original $350 back and keep whatever we made from the cover call contract. So hopefully I explained that correctly for you guys. Anyway, how do you do this? First thing you want to do is just go ahead and click on the plus sign. And as you can see, it's going to say long call, right? So $17 call, $3.50 times is going to expire on January 20, 2023. The total cost is going to be $3.50, right? As we scroll down, we see expected profit and loss. HBI price right now is going to be $18.26. It says that the expected profit and loss is $224, right? As we scroll down, we have a max profit right here that's unlimited. Max loss is going to be $350. That's pretty much saying that, hey, if it goes down to the price of $17, that would be the entire $350 that we put up. It can go down to zero and that will not change, right? So we have a break even of $20.50. So anything above $20.50 is going to be profit for you in terms of this contract. Anything below is gonna start taking out from the 350 that you put up, right? So one thing I want to say about the max loss is, remember, you're holding this contract until 2023 or January 2023. So even if it did drop down to $17 and you were negative 350, you can still do your covered call option trades to continue bringing in passive income. But as time goes on, you're going to notice that the price is going to creep back up. So what we're going to do is push on. We're going to go up real quick to kind of show you exactly what's going on. Click on continue. And as you can see, we have long call contracts, right? One contract equals 100 shares. So if you go with one contract, you're going to be paying $350. As you can see, if you type in, let's say 10 contracts, then you're going to pay a max cost of $3,500, right? So it's up to you. But if you do it 10 contracts, that means you're looking at 1,000 shares, right? So going to change that back to one. $350 is what you're going to be paying out for this contract. And then obviously you're going to click on review order, and then you'd have this long-term contract. Now, some people tend to bundle everything together. And what they'll do is that once they have this particular contract, as you can see, it says one. Once they have that contract, they'll go ahead and click on sell call, and then they'll come back up to, like, let's say August 6th, and they'll make sure that they come up to the 2050 mark, which is the strike price of 2050. They will click on this right here, and as you can see, contracts is one, limited price is $340, expires, good for you see max cost of $340, right? So remember, we're paying $350 up front, but because we decided to add in the cover call with the strike price of $20.50, they took that 10 cent or $10 and they minused it off of that $350, right? So the max cost now is going to be $350, right? Now, this covered call option contract expires on August 6th. So once it expires, that's it. It's done. And what we have to do is then roll on into the next contract. And I don't mean actually roll into it. I mean, once this expires, move to the next contract for the next week, right? So expected profit and loss, they're saying they believe that you will make $8.37 from this particular deal. And max profit is going to be $165.59. Max loss is going to be $161.76. And the break even is going to be $18.14, right? So let's taking a look at this right here. This is going to be your break even price of $18.14. And even at $18.14, you can see the expected profit is like 60 cents. If you go below that, that's when you're going to start incurring the cost. $69 incurred cost at $17. If you go all the way down to zero, then it's going to be $161.76. Anything above that, as you can see, it's going to start bringing in, making money for you, right? So at $20.50, you're going to have a positive $165.59, right? Anything above that is monies that you're not going to receive. But so that's one way of doing it. Now, what we're going to do is let's say we already own the contract, and we're gonna go back to the long call really quick and make sure that we clear it. So let's say we already bought the long call option contract, then we're just gonna go to sell call. Instead of bundling them in together, we're just gonna do them separate. And it's what I end up usually doing, right? I just do them separately so I can continue to move on without all the complications. And remember, or write it down on paper that, hey, I have to have a 2050 strike price to break even, right? So we would still do the same thing. We just go ahead and pick that $10 strike. If you believe that it's gonna be up there by August 6th, which I don't think is gonna reach $20.50 by August 6th, next Friday. But remember, I'm not a financial advisor. I'm just telling you what I would do with my own money. And I will go ahead and pick the 2050 strike, take the 10 cent or the 10 cent times 100 shares, which is going to be $10, right? Total credit to you is going to be 10 cents. As you can see, expected profit and loss is going to be $10, right? And then they're going to show you profit, or max profit is going to be $10, max loss is going to be unlimited, and the break even is going to be $20.60, right? So you automatically get $10 upfront in your pocket by doing this particular deal. And remember, you already spent the $350 upfront for the long call option trade, right? So once this expires, only thing you would need to do is go ahead for the next week, or let's say Monday, you will go on to August 13th. Now, you would do the same exact thing. You would go ahead and pick the 2050 again, and maybe it's going to be 15 cent, maybe it's going to be 10 cent, maybe it's going for 20 cent. It just depends on if the price is going up, right? The share price is moving up. So let's say it continues on with the 15 cent, right? You do the 2050, you've already taken $10 or 10 cent, right? So now your average cost is going to actually be $20.40. Hopefully you still following what I'm saying, right? The premium that you took from the week before on August 6th was 10 cent, which means that you lower your average cost or your strike price from the week before. Now it's actually $20.40. Now, what you're picking up for August 13th is the 15 cent, which means you're gonna minus that off if it doesn't sell at 2050, right? You're gonna minus that off of the 2040, which is gonna get you down at like 2025, right? So now total amount that you've made from premiums would be $25, right? And you would just do the same exact process over again, clicking on positive sign, taking a look at what's going on, and you would just continue on. Now, I actually have both of these clicked, so that's the wrong way to do it. I would have to clear the other one out. But I'm just showing you that you would just go on week after week after week, picking up that extra monies from the covered calls until you decide to get rid of the contract and sell it for more money, or you decide that, or it goes up to the 2050. So remember, it's all going to work the same as doing like your regular covered call contracts. If it doesn't make it 2050 and sell off, then you're going to repeat it week after week after week, or you can do it monthly. It's just up to you. But if it does reach your strike price of 2050, then the contracts are going to cancel themselves out. And remember, you already been paid whatever you've been paid up front, and you're going to make maybe a couple of dollars on top of that, right? Not much, but you should make a couple of dollars on top of that. Anyway, hopefully I've taught you guys how to do a poor man's covered call, and hopefully you realize that, hey, if you do this particular strategy, you don't have to put up a lot of money like if you're just buying the 100 shares straight out. But you need to make sure that you are dealing with good companies, right? You don't want to deal with something that is going to be a fly-by-night type company and you lose your money that you put in, right? So HBI is definitely a good company, known company, Hanesbrands. So once again, you guys, please like, comment, subscribe to the channel. I really do appreciate all the love and support that you guys have been given. And once again, hey, have a great day. Peace. Bye.